Welcome to On Course Financial, Charting Your Financial Future. This is the podcast for people who want clarity and confidence in their financial decisions. I'm Chris Brumlow. I'm a partner with the BAB Group. I'm a financial professional and an investment advisor representative, as well as retirement planning specialist. The BAB Group is a proactive accounting and wealth management firm focusing on individuals and small business owners to provide holistic advice when it comes to navigating their financial futures. We help those individuals and business owners understand their numbers, connect them to real decisions, and use them to plan for the future, not just react to the past. In our podcast, this is where we talk about the real intersection of business, taxes, retirement, and life planning. Each week, we focus on helping small business owners and individuals make clearer, more confident financial decisions without hype and without the guesswork. Welcome to today's episode of On Course Financial, Charting Your Financial Future. Deferring taxes sounds smart until one day you realize you've deferred yourself into a corner. I've sat across the table with people who did everything right. They saved consistently. They maxed out their 401ks. They followed the rules. And yet they look at me and say, Chris, I don't understand why retirement feels more expensive than I expected. Required distributions, higher tax brackets, higher Medicare premium. Tax deferral isn't bad, but blind tax deferral without long-term income planning can quietly turn into one of the biggest retirement traps that people fall into. Today, we're going to talk about why that happens and how to think about tax deferral in the right way. So, why tax deferral is so appealing? Let's start with that. Why is tax deferral so popular? Imagine you're 45 years old, you're in your peak earning years, you're making good money, your tax bill feels heavy, and someone tells you, put your money in your 401k, you'll lower your taxes today. That feels like a win because it is a win today. Let's say you defer $25,000 and you might save $6,000 or $7,000 in current taxes. That feels smart. And for years, sometimes decades, it works beautifully. The problem is that no one stops to say, okay, but how will this come out later? So the hidden assumption. Most people make one quiet assumption. I'll be in a lower tax bracket in retirement. Now, sometimes that's true, but let's take a real world example. A couple retires at 65 with $1.8 million in IRAs and 401ks, Social Security for both spouses. They have no pension and they have minimal after tax savings. On paper, they think we're retired, income should be lower. But then Social Security starts. RMDs kick in later. Investment income continues. Suddenly, their taxable income is higher than expected, not lower. Not because they failed, but because everything they saved was deferred. Now, when deferral turns into a trap, here's how the trap forms. At age 73, required minimum distributions begin. And let's say that same couple now has $2 million in tax deferred accounts. Their first RMD might be roughly $75,000 to $80,000. And that income is fully taxable. It's mandatory. And it's added on top of the Social Security. They don't need all that money to live, but they're forced to take it anyway and pay the taxes. And that's when people say, I didn't realize retirement would force income. And RMDs plus Medicare, what are the real consequences? Let's layer in Medicare. Medicare premiums are income based. So imagine this. A retiree crosses an income threshold by just a few $1,000s. That triggers a higher Medicare Part B and Part B premium. Those increases apply to both spouses and can last for years. They feel completely disconnected from the withdrawal decision that caused them. This is where people start to feel boxed in, not because they've saved too much, but because all of their savings live in the same tax bracket. Social Security taxation, that's a tax torpedo. This is one of the most misunderstood parts of retirement. Many people believe that Social Security is tax-free. But depending upon your provisional income, up to 85% of your benefit can be taxable. Now, here's a simplified example. A retiree receives $36,000 per year in Social Security, and they take $40,000 from an IRA withdrawal. That withdrawal increases their taxable income. It causes more Social Security to become taxable. So the $40,000 withdrawal doesn't just add $40,000 of income, it might effectively add $55,000 or more. This is where retirees are shocked when taxes spike unexpectedly. Marginal tax rates feel much higher than expected. This is not a math mistake, it's a planning gap. Now, retirement income is really a tax sequencing problem. Here's the realization: retirement is not about how much do I have, it's about how do I turn this into income effectively and efficiently. Two retirees can have the same net worth and wildly different outcomes. Why? Because one has a mix of tax deferred, after tax, and tax free assets, and the other doesn't. The more flexibility you have in where your income comes from, the more control that you're going to have over taxes, Medicare, and Social Security. Why the pre retirement window is so powerful. That most powerful time in your planning window is often between ages 60 and 73. Let's say someone retires at 62 and Social Security hasn't started, RMDs haven't started, and those years can be ideal for Roth conversions, filling lower tax brackets intentionally, reducing future RMDs. I often tell clients this is the time before the income storm, because once RMDs and Social Security stack together, options shrink and add to that uncertainty of future tax laws 10, 15, 20 years down the road. Deferral is a tool, not the plan. Tax deferral is not the villain. It's not the hero either. It's a tool. A hammer is a useful tool unless every problem looks like a nail. The goal isn't to eliminate taxes. The goal is to smooth them, control them, and avoid being surprised by them. I'll leave you with this. Retirement doesn't punish people for saving. It punishes people for not planning how savings turns into income. Tax deferral can help you build wealth, but without a plan, it can quietly take control away from you later. So at the BAB Group, we are very tax centric and we believe that the goal is flexibility, not forced decisions. So don't just ask, how much have I deferred? Ask, do I understand how and when it will be taxed? And do I still have choices? Thanks for listening to On Course Financial, charting your financial future. Joining us next time, and we'll continue charting this path forward and help you stay on course. As we wrap up today's episode, remember this: clarity leads to better decisions, and better decisions lead to better outcomes in business, retirement, and life. Our goal with this podcast is to educate, inform, and help you think more clearly about your financial choices in front of you. Now, before we go, a quick reminder. The information shared on this podcast is for general education purposes only and not intended as tax, accounting, investment, legal, or financial advice, and should not be relied upon as such. Every situation is unique, and decisions should be made upon your individual circumstances and goals. If you have any question about today's topics or how these topics apply to your specific situation, we encourage you to consult with a qualified professional. Thanks for listening to On Course Financial, charting your financial future, and join us next time as we continue to explore the ideas, strategies, and insights that help you move forward with confidence and stay the course.